Welcome to the Saturday Market Recap Letter, and what a week it was, folks. The market is absolutely crazy. October 21st, 2023, and remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And this week, oh my gosh, the market is trying to hold on as interest rates have increased almost every day this week. 30-year mortgages are above 8%, which is the highest since the dot-com bubble broke. And a lot of you are not born when that happened. In our weekly stock analysis video, well, Netflix added 9 million new subscribers and gained 15% in one day this past week. The numbers are looking great for this stock going forward, and we're looking at more than a double by the end of 2024 for this stock. Actually, we're looking for more than that, but we'll be happy with the double. And our ETF video, well, our hedged ETF, it's a great time to be looking at a hedged ETF. Our ETF portfolio is made up of the best 5 stocks from 6 different ETFs. Year to date, it's up 21%, which is more than doubling the S&P 500 index. The exciting part of this is this year it has 78% less risk than the market. Folks, this is phenomenal. And let's get into the market since we're talking about it. And the top red line and the bottom red line are volatility bands, and the center line is a 20-day moving average, and the market had a nice rally up to that 20-day moving average. It defended it quite 5 or 6 days in there, then all of a sudden fell because of rising interest rates, and now we're sitting on that bottom band, which does not excite us very much, for folks. That is a very, very dangerous place to be, especially since this indicator, our intermediate term indicator, looks like it wants to turn down. In fact, if that blue line crosses over this red line by the end of the day, I'm recording this just about an hour before the market close, if this blue line crosses down over that red line, we have a sell signal here, and we don't want to see a sell signal right now, folks. And let's look at a shorter time frame on the market. And this was our sell signal up here. First, we got a buy signal. That gave us a little rally. And then we got a sell signal up here. And that was because interest rates were rising, and it caused this line to go down as the market went down. This blue line is the 50-day moving average. And you can see the S&P went up to that and couldn't break through that 50-day. There's the failure right there. And then interest rates started rising. It came down. This is the 200-day moving average, folks. This is a very important line in the sand, as many, many investors watch this line. They buy when the market goes above it. They sell when the market goes below it. So we might be looking for some selling on Monday. And here is that intermediate term indicator again, and you can see how it's turning over. But folks, I'll tell you what, if the market can regain its composure next week and this turns back up, we can be generating a buy signal in here. But we have to see some up days next week, and Monday can be a tough day because usually when Friday is weak, Monday is also weak. In fact, if Friday is strong, Monday is usually weak. So Monday, especially in the morning, is going to be a tough morning. So we're backing away from this market, even though we're fully invested with our long-term portfolios, because the market is causing interest rates to rise, and the Federal Reserve is stepping back, and the talk is they may not be raising rates until next year if they have to. And others talk by some of the Federal Reserve voting members of the Open Market Committee are saying no more rate increases. So if we're near the end, this market is going to make one more thrust down, and this might be it. One more thrust down, and then we will have a good market going into the holidays. But it's got to get rid of this September, October week period area in here, and we still got another 10 days to go until the end of this month. And folks, today, the October 410 SPY 410 put that we have, and this is for about $135,000 portfolio. We always want to have 3 puts in that. Since this put expired this morning, we sent out a letter to buy the January 410 put. And folks, we are about 3% away from this 410 level. What does that mean? If we go down another 3%, our portfolio, if you have 3 puts for every $135,000 worth of stock in your portfolio, you will be totally protected. You could go to the beach all next week and not worry about the market falling. That's what these puts are for. So folks, this morning we went out and we bought the January 19th 410 put. We got a better price than at the end of the day because the market continues to fall. So we're set. If you're into portfolio protection, you've got it. You don't have to worry about a thing. So folks, we had a tough week this week with interest rates rising. The only bright spot out there seems to have been Netflix, and everything else is pointing down. And in our ETF letter, we show some of the ETFs that are all pointing down. And a good thing we're hedged in that portfolio. So we're doing very well. In that portfolio, we're up 21% for the year, and we have 78% less risk than the stock market itself. So, folks, we're happy. If we have put protection for our growth stocks, we're happy. If we're in the ETF hedged portfolio, we're very, very happy. So, folks, go out, enjoy yourself. This is the beach. The sun is coming up, or it's getting up there about 11 o'clock in the morning. Sit here on these chairs, enjoy that beach. And folks, don't worry about next week because it's going to come one way or the other. And if you're hedged, you don't have to worry about a thing. All right, folks, you take it easy for the weekend. Stay well. We'll see you next week.